We want to bring in a widely followed technical analyst who sees danger ahead for stocks. He's John Roque. He's Managing Director and Senior Technical Analyst for WJB Capital Group. He joins us on the phone from New York. John, great to have you here with Matt and myself on Street Smart. I know we've got Adam Johnson we're going to bring into this as well. So you've got your eye specifically on financial and technology stocks. I mean, tell me what, though, in general, all of this is starting to tell you about the market and where we head from here.
Well, Carol, thanks for having me. But heretofore, we've been reluctant to make a big market call. And to be quite honest, we're reluctant to make a big market call here. What we think is more important is to have a big sector call. And the sectors that we want to be underweight or to look for shorts in are the financial and the technology sectors.
Why do you say that? I mean, what are the technical indicators pushing you to make that decision, even if you're reluctant to do it?
Well, Matt, with respect to financials, I'm going to just cut it down just a little bit. What we do is we want to be short big cap banks and big cap brokers. The insurance stocks are still fairly well together from a technical perspective. But the fact is that financials don't win, especially big cap banks and brokers, on an absolute basis, and they're clearly already bearish on a relative basis. So if we had a baseball team here, they're not helping us either with offense or with defense. And we think that to get them out of your portfolio, you're actually doing a better job than keeping them around. We've heard of late that these stocks represent good value and that these stocks are cheap. Well, from a technical perspective, we might not understand the definition of value, but we also want to buy cheap stocks, but only if they're going to go up, not if they're going to go down.
You know, John, it's Adam. Speaking of going down, I know one of the things you look at is to what extent stocks are above their long-term averages. I've got a chart that I know you can't see because you're on the phone, but our viewers can see it. I want to pull it up for them, and it's simply the percentage of stocks above the 200-day moving average. Right now, it's about 69%. The concern is it could fall back to where it was, say, last summer, 30%. Help us make sense of this, please.
Sure. So we have data, as anybody on the Bloomberg has data for this indicator going back to 1994. And what you'll notice from the chart is that in prior years, like in 1995 to 1996, 03 into 04, 09 into 2010, when you've made lower highs in this indicator, as you're doing now from 2010 into 2011, that you tend to have an important corrective phase. And Adam, you said it, you know, you could get down to 30% of the NYSE above their 200-day moving averages from near 70% here. So this could be a fairly big or important corrective phase for the entire market.
Hey, John, so question, if that's what's going to happen, you're going to actually cut the number of stocks above their long-term moving average in half. How far does the S&P go down in that case?
That's a tough part of the question, so thanks for asking it. What we're looking for here is we would expect that there's risk in the S&P down to the 1250 level, which is the March low, which is still above or joined by an upward sloping 200-day moving average. We don't think that that is a tremendous corrective phase. Now, please remember, at the outset of this interview, we were reluctant and remain reluctant to make a big market call. But we believe that if the market does correct, as that indicator is suggesting, that the groups that will outperform perform most poorly would be financials and tech, and that's how we think a short seller is able to outperform, by focusing on those two sectors.
John, let me just get you to repeat some of your logic here, because you guys are technical analysts and you're talking about value propositions for tech stocks. I mean, if we're seeing something trade below its historical average as far as the price-earnings ratio, what technical indicators push you to make a value call? I mean, if it's cheap, right?
Well, not necessarily. What if you're only using valuation metrics that go back to the mid-90s? What if you should be using valuation metrics that go back to the 70s, when financial stocks were 4% market cap weighting of the S&P 500? They peaked at 22% in 2007. They got down to 8% or so in the spring of 09, and they've rallied back more than 100%. Now they're deteriorating again to 15%. So if you're using metrics that only go back to the 90s, but you should be using metrics that go back to the 70s, maybe these stocks really aren't cheap. At least that's what the charts are suggesting, that they're not cheap enough yet. So perhaps those who contend that these stocks offer good value here, these stocks really are just value traps.
Speaking of cheap, John, I don't have to tell you, many think some of the bank stocks over in Europe are cheap at this point. I want to talk a little bit about Europe, because that's certainly impacting the trade here in the United States today and really around the globe. The Euro Stoxx Banks Index has been at or below its 200-day moving average for more than a year. So talk to us about this trade and what it tells you.
Well, Carol, that's a good point. we pay very close attention to the ability of stocks or sectors or groups or markets to ignore bad news and, of course, to embrace good news. And if these stocks are indeed cheap, then they are ignoring what is good news, which is really a bad sign. So they are joined by a downward-sloping 200-day moving average. And I'd hasten to say that there's probably nobody in our business who's made their great wealth ever buying stocks that are still below downward-sloping 200-day moving averages. So we continue to think that it is prudent to be out of these Euro financial stocks. And, of course, we think that they are providing some sort of lead-in for the performance of our financial stocks, because ultimately they are going to go in the same direction, both Europe and here.
John, you bringing it back home here, you think Goldman Sachs, Morgan Stanley are good examples of this as well?
Correct. We've been negative on both of these stocks for a long time, going back to the autumn of 2009 when we wrote a report on Goldman Sachs entitled The Last Emperor. And we've had a downside target for Goldman for $100 for a long time. It was wrong for a while, and it looks like it's working in our favor here. Goldman doesn't perform well on an absolute basis. And as Carol noted for the Euro index, this stock is now below its 200-day moving average, and actually it peaked. Its most recent peak was in October of 2009. So if things were really good for Goldman's stock price, we would think that it would not have peaked in 2009, but would be doing better here. Mm-hmm. And Goldman, relative to the S&P 500, peaked in the autumn of 2009 and has been in a downtrend since. So we think that both of these stocks are likely to work lower.
We got to run. John Roque, thank you so much. We appreciate your time this afternoon.